Hey, what is up, people? Hope all is well. You must be wondering, in the current context of UK mortgages, whether to choose a variable rate mortgage or a fixed rate mortgage. Well, before we dive right into the video, you're watching WIS Mortgages, Accountancy and Insurance. Don't forget to subscribe to our YouTube channel, smash that like button, and don't forget to click on the bell icon to be notified on the latest and greatest of UK mortgages. So to answer to all your questions, we have Iftikhar Mohammed, who is a mortgage advisor and also a qualified accountant. He's been the best of both worlds for the past 10 plus years. What is up, Ifti? What's going on in the market right now?
Hi, Pradesh. How are you doing? Are you okay?
I'm doing good, thank you. How are you?
I'm very well, thank you, Pradesh. And the answer to your question is what's up is like the interest rates are up at the moment. Unfortunately, that's kind of the situation at the market. So we are all hoping for some good news somewhere down the line. But unfortunately, the interest rates are up. So unfortunately, that's the answer.
Let's start with as simple as what a fixed rate mortgage is.
Okay, so fixed rate mortgage is exactly what it says on the tin. So it's fixed, right? So if you take a sort of a mortgage for say 25 years, you can have a deal with the bank for say 2 years or 5 years. During that deal period, the mortgage rate is fixed. So if you take a 2-year deal on a 25-year mortgage, so during that first 2 years, you know how much exactly you're going to pay. So that is a fixed rate mortgage. So if you take a 5 years, you know that your monthly payment is going to be static and it's going to be fixed for that 5 years, right? So that's what a fixed rate mortgage is.
Opposed to that, what exactly is a variable rate mortgage?
Okay, so variable mortgage is the total opposite, right? So a fixed is fixed, you know how much you're going to pay, but a variable is variable, which you don't know how much you're going to pay, right? So that's the main difference between a fixed and a variable mortgage. So on a variable mortgage, it's generally attached to something like the Bank of England base rate or the bank's internal rate, which is called a standard variable rate. So if that component changes, the Bank of England base rate or the variable rate, your monthly payment can go up or down. At the moment, a lot of what we see is the rates have been going up over the last few months. So therefore, if you're on a variable rate, you're likely to go up if the interest rates go up, right? But if it goes down, you'll benefit from that as well. So that's the difference. So you don't know how much you're paying the next month or the month after. You still have an option to take a 2-year or a 5-year sort of deal, but the rate, you don't know what you'll end up paying or what you're going to be paying in a year's time. You just wouldn't know that, right? Because that could vary. So that's a variable rate mortgage.
So many people are not aware of the fact that there are so many types of a variable rate mortgage. If you could explain the different types of a variable rate mortgage.
Yeah, that's a very good question, Pradeep. A lot of people come to me and say, can I have a tracker mortgage, right? So tracker is one type of a variable mortgage. So there are at the moment about 3 types of variable mortgages. The most popular is obviously the tracker, right? So what a tracker mortgage does is it tracks Bank of England base rate. Like I mentioned earlier, it's connected to something. So if somebody takes a tracker deal and if say Bank of England base rate is 3%, and the bank says, yes, your deal is 3% plus 0.5%, right? So 3% Bank of England base rate and 0.5% on top. You will be paying 3.5%. So tomorrow, if the Bank of England increases the base rate by 0.5%, your rate goes up by another 0.5% as well, because you pay 3% plus 0.5%, and now it's 3.5 plus 0.5%, right? So it's attached to that Bank of England base rate. So that is a tracker, but then you have something called a discounted rate mortgage. Now that is also quite popular at the moment. What happens with a discounted rate mortgage? It's not connected to the Bank of England base rate, but it's connected to the bank's internal rate, which is called a standard variable rate. So if you take a standard variable rate, right? So let's say X banks charges say 6% as standard variable rate. On a discounted product, they give you a discount on that internal rate or the standard variable rate. So if it is 6% and they say we give you a 2% discount, your rate to start off with will be 4%, right? So if somewhere down the line they decide to increase the standard variable rate or the internal rate to say 6.5%, you still get that 2% discount, but your rate will go up to 4.5%. So like I said, it's connected to the internal rate or the standard variable rate. So that is the second type of mortgage you have when it comes to variable. And the third one is the standard variable rate itself. Now, a standard variable rate is the internal rate of the bank. Usually we call it the reversionary rate, right? So once your mortgage deal finishes, if you do nothing, right? So you don't change your deal, you move to a standard variable rate. So the standard variable rate is what that is, right? So every bank will have a different standard variable rate. Every residential mortgage and a buy-to-let have two different sort of types of standard variable rates. So the standard variable rate is the internal rate that the banks use for mortgage lending for its customers, right? So usually what happens is when your deal finishes, like I said, you move to a standard variable rate.
Getting your mortgage online doesn't have to be complicated. At WIS, our website will help guide you through step by step. Our fully qualified advisors can help you get the most suitable mortgage for you. Then you can relax, safe in the knowledge that WIS are working in the background to get your mortgage approved. WIS. Online mortgages made simple.
So from the sounds of it, variable rate mortgages seem to be quite volatile. They seem to involve a lot of variables, and this can make things quite difficult for mortgages, especially when it comes to budgeting their monthly payments. So despite all of this, what is the reason behind the popularity of variable rate mortgages in the current context of UK mortgages?
I mean, I think you explained that very well, right? Because for budgetary purposes, a lot of people are not comfortable with variable mortgages. But at the moment, like you said, it's quite popular, the variable mortgages. The reason why it's popular is because the fixed rates currently is hovering around 5.5%. But whereas the variable mortgages like trackers or sometimes even the discounting mortgages, they hover around, say, 3.5%, right? So there's a difference of about 2% at the moment, right? So what a lot of people say is, I'll take a tracker for example, right? So if the rate is 3.5% on the tracker, for them to actually start feeling the pinch of a fixed rate, right, the rate has to go up to about 5.5%, right? Because that's their alternative, right? So if they didn't take the tracker, the alternative is 5.5%, right? So therefore, they benefit from that at least till the point that the interest rate goes up to that, right? Of course, there's a risk that it can go beyond that 5.5% because if that's your alternative, right? But people are happy to take that chance, right? Because for a lot of people who's been paying 1.5% interest, 3.5% is a jump, right? But just imagine if they have to pay 5%, right? So that is a massive jump. So yes, on the face of it, it looks cheaper, and therefore a lot of people prefer that option. But there is still few people who go for a fix, right? To be honest, there's quite a lot of people who still go for fix. But the reason why they do that is because they want that certainty, because they're worried that the interest rate might go up. Because in the press, you hear so many things, right? So obviously those are all speculation, but they look at worst case scenarios and things like that, and that sometimes worries people.
So for someone who's been on a fixed deal and have felt the comfort of certainty in their monthly payments, is it a good idea for them to revert back to a standard variable rate?
Again, it depends, right? There's no right answer to these things. As advisors, we always look at circumstances before we make a recommendation. But this is a popular question because a lot of people look at their fixed rate and say, look, I'm getting a 5.5% fixed rate and standard variable rate, say, is around that sort of range, right? So should I just be on the standard variable? Why do I have to fix myself for the next 2 years? I mean, that's a fair question, a good question as well. But the point here is because of, like you said, the market is quite volatile at the moment, right? And there are talks that the interest rates may go up further. So if you sort of stick to your standard variable rate, you have no control over that because standard variable rates are anyway on a higher side when you compare against the other variable products, right? So if it goes up further, that will go up as well, right? compared to that fixed, sometimes it's a very good option because you know that if it's 5.5%, it's 5.5%, right? But if the standard variable rate is around that, let's call it for argument's sake, it's the same. If Bank of England next month increases its rate, right, you'll end up paying more and more and more, right? So along with that, fixed rates may go up as well, right? So you miss out on that opportunity. So, if you're comparing with that, maybe it's a good idea. Again, it depends from person to person. You have to look at circumstances before deciding what's best. But the other alternative is, if you're trying to go on a standard variable rate, like I said, it's a type of a variable product. So why don't you compare it with a tracker product? Because there are tracker products which are about 2% difference between a standard variable rate and a tracker, right? So you might still cover that cost of a product fee in the next 2-3 months, depending on the size of the mortgage, right? So if you have that option, you might want to consider going to a tracker instead of staying on the standard variable rate or a discount or something similar, right? Because standard variable rates are generally quite expensive. And there are some products out there like a tracker discount, which doesn't even have a product fee, right? Because you're worried about a product fee, you still might get a better deal out there by going to one of those products. Remember, a lot of these tracker products come with a no ERC, that means no early repayment charge, right? So which means like if you break a tracker deal, you don't have to pay a penalty. So that's the beauty of some of these tracker products, right? Or sometimes even the discount you get this, right? So if you go for a product like that, and if you are not comfortable, you can always move to a fixed deal in between. So you can do that, right? So I think that will be a better option than sticking to a standard variable rate. But again, depends on circumstances, depends on the person, the answer will vary. But that's becoming a little bit more popular because people are starting to compare trackers with standard variable rates, and they are finding it a little bit more comfortable sticking to that rather than sticking to the standard variable.
Right. Yeah. So the highlight of what you said is, despite all the options available to many of the people, it really boils down to everybody's personal circumstances so that they can have the right product chosen for them. All right. So thank you very much, Ifti, for explaining all this information elaboratively. I think many of our viewers would find it very useful. I think that's it for the video today. Thank you for watching. And if you have any questions at all, don't forget to drop them down on the comment section below. If not, we are a bunch of friendly people. You can call us on 02 03 0111 986.